Welcome one and all back to another video. Today I just wanted to show you guys a quick little spreadsheet of what I'm actually doing, what a real investment looks like, because I'm seeing a lot of misguided souls out there. A lot of people that it's basically a market out there where people think that if you hold something for a week or 4 weeks, 5 weeks, it should go up by 100%. So that's not investment. That's just speculating. That's hoping that the price goes up. And I just wanted to address some of that by showing a little bit of what I'm actually doing. I asked you guys on my Instagram story what you guys are buying out there. I'll show a couple screenshots on the screen right now. Some of you guys are buying some very speculative things. If you make some money, good job. I'm not going to down you for that, but I just wanted to give you guys a little bit more of a level-headed perspective and start off the video with something that I call you can't fake it. So a lot of people come up to me because I used to be an athlete. I know a little bit about exercise. They tell me, how do you get in shape? They ask me, how do you get in shape? And I always tell them, you can't fake it. You can't fake being in shape. People like that in shape look because it looks like you're strong. If as a man, it looks like you're strong, or as a woman, it looks like you're in shape. Instead of focusing on losing the weight, I always tell people, just focus on being in shape. Your favorite athlete that you like their body, they don't focus on losing the weight necessarily. They focus on their performance. So you got to focus on performance. Same thing goes for money. You can't fake it. You can't fake being rich. The narrative out there on YouTube is that the way to get rich is you just get into these stocks that are going to the moon, and that's how you do it. When the reality is, throughout history, the real way to get rich is to provide a valuable service and to not squander your money. So one way to easily squander your money is to use all of it on an investment that's not making any money, investments that aren't paying any dividends, investments that aren't going into the future, and they don't provide a very valuable service. So that's what I wanted to talk to you guys about today. Things that I'm buying that actually have a future, things that I'm buying that actually pay a dividend, things that I'm buying that actually have earnings. And the reason why I'm buying them will be evident in a second here. So I had a conversation, just one more little quick sidebar. I had a conversation with somebody, and I was asking them what they're buying. And the reason why they were buying it essentially was because they thought it was going to go up in price. And they asked me why I was buying what I'm buying, which I'm about to share with you guys. And I said, because it's going to pay me until I die. So anyways, without further ado, let's get into this little spreadsheet here. So this is my cash flow spreadsheet. I'm going to put this on the screen right here. The cash flow spreadsheet basically tells me monthly what I'm getting in rents, monthly what I'm getting in interest from my bank accounts, 3% interest on the bank account. If you want to get that, link down below in the HM Bradley account. So we've got $86 in monthly dividends, $39 in monthly interest. We've got $1,400 in monthly rents, and my cash flow per month is $1,525. So that's $18,306 that I make every year for basically doing nothing. And I haven't been investing for very long. That's a lot of money to be making for doing absolutely nothing. That's the beauty of compound interest, is that very quickly, if you put yourself in a situation where you can have assets, you control businesses, you control real estate, you basically can get paid to do nothing, essentially nothing. So I wanted to quickly share that perspective, which is that investing in these assets, they're the things that's going to work for you when you can no longer work. So essentially over time, if that's at $18,000 now, who knows, 10 years from now, it could be at $180,000. 10 years from then, it could be at 1.8 million, 18 million. The beauty of compound interest is that as you keep on stacking up these dividends, you keep on getting these companies that actually produce things, these companies that actually make earnings. When you own them, you get to keep the earnings. So all these other stocks that don't actually make any money, a lot of them you see on the internet right now, these penny stocks, they don't actually make a profit. What you're buying is essentially the promise that one day they will make a profit. And then typically when a company goes from not making a profit to making a profit, they're going to continue to invest that money back into the business. And then once you're buying into that, you're buying into something that will eventually pay you. Instead, another strategy is to not try to get rich quick and just buy something that already will pay you or that already makes a profit. So let's get into those really quick. And after that, we'll close out the video. So the first one I want to bring to you guys' attention, and this is a shout out to PPC Ian for bringing this one to my attention. I've been looking at this one, haven't bought into it yet because I just bought this here MacBook for $2,800. That's a significant amount of my money. I don't make a ton of money at this point in my life, but just bought this MacBook, so I can't buy any CHD right now. However, I do love their brand. If you look at their brands here, you know, pretty much any American, any normal person would recognize a lot of these brands. You got Arm & Hammer, you've got Trojan condoms, you got Kaboom, OxyClean, Nair, multivitamins, things that people are going to buy in any market, essentially. They pay a little bit of a dividend. I think it's about a 1% dividend, but it's a great company. This company is not going anywhere. You know that in good times and bad times, they're going to do just fine. They're not going to go out of business. You know, people aren't going to stop using kitty litter because the economy is down. People aren't going to stop washing their clothes because the economy is down. Pregnancy tests, people are not going to stop having pregnancy tests when they're stuck inside during this pandemic. So we all know that, you know how that goes. But anyways, I just think that these are great brands and their earnings look promising over time. So moving on to the next component here. As we see here, the revenues look pretty good. The revenues are actually growing. So this company is growing. They are actually still investing into their business. The 3-year dividend growth rate is about 26%, and the payout ratio is about 35% forward. So based on this year's earnings. So I do like that they have a low payout ratio. They have room to grow that dividend. They also are investing into their business. They're growing their revenues. So this company is one that I can see growing into the future. And like I said, it's a very stable player. It's one that I am confident that for at least the next 10, 20 years, it'll continue to pay me until I die. So anyways, I just made it sound like I'm going to die in 20 years. That's a little dark, but moving on to the next one, energy sector, XLE. So the reason why I'm buying into this one, I'll explain it in the next tab that we've got going on here, is the energy sector. I think that it's undervalued right now. So at the beginning of the pandemic, energy went negative, right? The gas prices, oil prices went negative. If you guys remember that, the futures on the oil went negative. That's because people stopped driving, people stopped flying. But with these vaccine rollouts, I'm pretty confident that a lot of this demand for oil is going to pick back up. Additionally, there's some things going on with OPEC, or in other words, all of the oil partners over there. So basically, they kind of have this, what I would describe as like a cartel, and they're restricting the supply in a way that is going to probably lead to oil prices going up. But that is a little bit controversial, because if they allow oil prices to go up to a certain amount, then it becomes profitable for the United States to start producing oil at a higher rate. So then those oil companies abroad that have an advantage as far as low cost producing, basically if they don't have enough supply of the oil, they can't keep the price down low enough to where the United States can't compete on price. So it should be interesting with these multinational oil companies. Let's go into what this oil ETF actually holds. So they've got 24% ExxonMobil, 21% Chevron, 5% ConocoPhillips, and down there we see a bunch of other big oil giants. So the reason why I wanted to buy into XLE is because I see the oil sector growing as a whole. However, I don't want to bet on any one specific oil company. So instead of betting on one oil company, essentially what I'm doing is saying, I think that the oil industry is going to do well. I think that it's undervalued right now. So I'm going to step back. I'm going to buy into Exxon. I'm going to buy into Chevron. I'm going to buy into ConocoPhillips, because I think that in general, the sector is going to do well. But I'm not willing to bet on any one individual company because I think there's just too much risk there. So let's go into why oil prices are rising. In January, Saudi Arabia agreed to unilaterally cut its oil output by 1 million barrels a day in February and in March, in a move that would offset higher production from some allies, particularly Russia. At the time, OPEC also confirmed that it would ease production to 7.2 million barrels a day from 7.7 million barrels a day, and reassess output levels monthly, allowing for adjustment of up to 500,000 barrels a day. So like I said before, if they are to basically restrict the supply, the price will go up. However, if the price goes up high enough, this will help for oil producers in the US, because one thing that's interesting about the oil industry is that it's not necessarily that there's no oil in other countries. It's just that it costs more to extract it from certain places. So once the price of oil goes up and you can basically compensate that cost of extracting the oil, then you can extract oil in more places. So moving on to the third share that I've got on here is SPHD, or high dividend, low volatility. So let's just go into the holdings. Basically, this is a monthly dividend stock. It's very popular. One negative thing about it is that the expense ratio is 0.3%. So that's a little bit expensive for an ETF. But let's go into the holdings that they've got here and tell you exactly why I like this for a turnaround play. So they've got some stuff in there that's very stable, that continuously produces no matter what the times are. But they also have some turnaround plays in here. So let's go through these sectors. So we've got basic materials. That's things like oil, things like aluminum, things like steel. Those guys, as the prices of things go up through inflation, I think that they're going to see a boost there. Consumer cyclical, like obviously when there's a downturn in the economy, those get hit the hardest. So I think that's going to be a good turnaround play. I think financials look good here in price. They've been hit pretty hard. Real estate's been hit pretty hard in price. Healthcare, that's just pretty steady. Utilities are going to be steady. Energy, we just talked about energy. I think energy is going to be a big beneficiary here. They're pretty low in techs, but typically you're going to be talking about your IBMs here, ones that have been beaten down a little bit more, rather than your kind of stay-at-home plays, the high flyers that are going to be in your Russell 2000s. So I think that a lot of these, as you look at it, a lot of these are going to be very big beneficiaries of reopening, going to be very big beneficiaries of prices going up as a result of inflation. So I think that these are just good turnaround plays. In addition, this pays me about $40 a month in dividends. So it's good to just see that steady figure, that $40 a month, getting paid back to me in dividends based on the shares that I own. So I like that one. Might continue to buy into that one, or I might shift into tech. It depends. If the market shifts down really quickly, I think we're near a top right now, but don't quote me on that. But if the market continues to sell off at some point, I'm probably going to shift into more growth names. But I think that value looks best here. All right, and for our last one, I actually have a growth stock, if you want to call it that. It's actually a pretty established company, but it is Facebook. So the reason why I like Facebook here is because it kind of looks like Apple looked back in 2018. December 2018, Apple was getting absolutely hammered. Pre-split, it was about $140 or so. And at that point, even though I used some of those proceeds to pay off my student loans, I was buying Apple heavily. And I really want to buy Facebook here heavily because the forward PE here is 19 when the market is trading at about a 29 or 25 forward PE last time I checked. So if the market as a whole is trading at a 25 and Facebook, a company that's growing pretty huge, is trading at a 19, that's something that you got to be attracted to. A lot of people are off-put by the two factors that are kind of dragging it down right now, and that's Apple not letting them target ads, and the other one is big tech is trying to, or the government is trying to break up big tech. I don't really think that those are going to have huge impacts just because Facebook has so much power as far as advertising. I think that they're going to have big influence over time regardless of any of that. Facebook is one of those stocks that has always had a lot of bears on it, and it never plays out in the earnings. Every time you see the earnings are great, and it just never plays out in the stock price. So it's one of those companies where every time they keep on earning more and more and more, you don't see that multiple expansion. So one way for a stock to go up is by increase their earnings. The other way is multiple expansion. So what I think is next for Facebook is multiple expansion so that they'll stop being disrespected and start being treated like the rest of the stocks that are in the tech space. So last couple notes about Facebook is that they own really great brands. They own Facebook, they own Facebook Messenger, they own WhatsApp, they own Oculus, and they just have a big opportunity in Oculus and all of these other advertising services. You see them expanding every single year, and their multiple is contracting every single year. I think that there's a lot of room for that multiple to expand because of these things. And quite frankly, they're getting in pretty good with the politicians. So as I see what they're doing as far as the regulation, this is just my own personal opinion, I think that they might see a little bit of decrease, a little bit less heat from the politicians just because they're giving them what they want. So as long as they're giving them what they want, then they'll probably get what they want, which is left alone. I don't think they're going to end up getting broken up. Other things I see with this company, and shout out to Jeremy from Financial Education for pointing this out, ad rates are increasing. So ad rates are increasing as far as if you want to actually put an ad on Facebook or on Instagram. He actually puts lots of ads on Facebook and on Instagram. If you haven't seen his ads, you probably will at some point. But ad rates are going up. So that's another good thing. They have some pricing power there, because who doesn't have a Facebook? Who doesn't have an Instagram? Almost everybody has those avenues. So if you want to advertise as a small business, you're probably going to do it on Facebook. You're probably going to do it on Instagram. You could do it on YouTube, but it's going to be on probably one of these big tech platforms. So $60 billion in cash. That's beautiful. I love to see that, because a lot of these other companies, they either don't make any money, or they don't have any assets, or they don't have any cash. They don't have any ability to actually grow. And if they want to grow, they're going to have to do it through using debt. So anyways, that is basically what I've been looking at. Been looking at Facebook, been looking at Church and Dwight, been looking at SPHD, been looking at XLE, because I like what's going on in energy, but I don't want to bet on any individual energy stock. So anyways, hopefully you guys got the message out of this, which is get rich slow, don't try to get rich fast, because the get rich fast is a myth. The get rich fast is great for selling courses. The get rich fast doesn't actually exist for most people. So anyways, hopefully you guys liked this video. If you did, make sure you give it a thumbs up, and check out my links down below. You can get some free stocks from Webull. You can get some free stocks from Robinhood. You can get checking account bonuses, credit card bonuses. You can probably make about $300 easily down there if you go out to the description, and I'll see you guys in the next video.